Hi, Peter Rose, Longwood Currency Trading. Good morning. It's November in 2020. I have my coffee and I have a topic for you today. That topic is a simple probability analysis in Forex trading. And look, I've got, physics. You all know I got a physics background and a math background, so I could put everybody to sleep in about 42 seconds. That's not the goal today. I am going to be discussing some mathematical terminology and showing some stuff about that. But most traders are probably not going to have that background. You're probably not going to understand that stuff. But you need to understand what the principles are behind probability theory, so that when you're looking at trading, you can speak correctly as to how you're evaluating either the position that's current or whether you want to get out of a position, or the example that I'm going to give later is how do you manage a position that's in profit and that you're going to get out of it. How do you determine those? On so many of the videos that I've had done in the past, I talk about the simplicity of trading and the probability of doing something is this, and when it's that, then you're going to want to take the trade when the probability is higher. Well, what's the underlying thought process in that? Do you really have to do mathematical calculations in order to come to a probabilistic determination of whatever the hell it is you're going to do, that it's okay to do it? The answer to that is no. So the video will be as little math as possible, and as I always do, try to focus on the principles of what I'm trying to talk about. That's why I don't go to the board very much and do very much diagrammatic stuff. I'll do a little bit of that today, but not too much. So stay tuned. We are going to get on with that. Yeah, but before we do get on with it, several folks who've seen these videos have commented on a weird thing that crops up in the background. I'm in my library at home, and they say, "What in the hell is that? It looks like a cane." And I have my cell phone on so I can see that I'm at least in frame here, and there is a cane, and it is in the view. I'm going to go get it. Stand by. Here it is. It's a cane. You can kind of get a sense of the craftsmanship involved in this cane, and the dedication here to Grandmaster Peter Rose. That'd be me. It's a cane by Cane Masters International, custom made by Cane Masters International, of which I hold a black belt in the old Cane Masters system and using a cane. And this cane, I'm going to put her back now. Yep. So in my teaching of the cane, I don't have very many students and only teach karate students that I currently have the cane. I don't teach this just to random non-karate people, because they're frankly quite not disciplined enough to do the work to do cane stuff. But anyway, in the folks that I teach, we name our canes. We give them a personality. And my cane in this instance happens to be Janice, named after Janis Joplin. So that's the story on the cane that sits in the background. I had a visit. My son came over last night, and we went outside and to the fire pit. My wife Sue and I went to the fire pit, and we sat around the fire pit, had pizza, and sat and drank a few beers and had some pizza. And so my son comes over and he goes, "Jesus, Dad, your hair is really getting long." And I've had some folks comment on that. Who is this guy? Is he trying to catch up with the scruffy trader, my friend Langers, the scruffy trader in the UK, as to No, I'm not. I'm not emulating. I'm not trying to be scruffy. I haven't had a haircut in a year. I usually have my hair long, but with the COVID-19 pandemic going around, I personally don't feel like going down and getting my hair cut, and I really don't need to because I'm effing retired, and I don't really give a shit. And so that's the story on the long hair. If it concerns you and bothers you, because someday I'll flash on screen and it'll be cut. So there you have that. Solved 2 problems of things, but I appreciate the comments. So because the discussion of probability theory is fairly complicated. I mean, there's courses in mathematics that cover probability, and so I'm not going to try to teach probability here. That's beyond the scope of what anybody's interested in, and also what I feel like talking about. But probability and what is produced by experience through gauging different probabilities. We talk about intuition and gut feel. I've told you before about the marvelous book that Curtis Faith wrote on trading with your gut. All of those things come from experience, and the experience is based on some wins, a period of wins, and a number of losses. And that creates a thing that we're going to call probability distribution. And from that, you can determine a current situation, what the probability is that it will be successful based on the elements that comprise that situation. So the initial part of the discussion that I'm going to do, and I'm hopefully going to keep this really short, is going to deal with just 4 topics. First, we're going to talk about probability. Then we're going to talk about probability distribution. We're going to show how you get a standard deviation out of that and what that's all about. And we're going to talk a little bit about variance. And it's really the variance that alerts us to what the probabilistic consequences are should we make a particular choice. So we'll be talking about that stuff. And because I don't want to get lost in the topic here and bore anybody, I've got some notes. Here's my notes. So I'm going to be constantly looking down at those notes and making sure that we're going to stay on track and try to get this thing done in a reasonable amount of time. Specifically, get it through the math definitions and my little example so that you get kind of a sense of a feel for that, and then get into how that's applicable toward the trading. Now, we're not going to, trust me, we're not going to be talking about probabilistic analysis for trading because that's complicated. I'm going to show you how you can do that the simple way, through experience and not through mathematics, okay? So don't get your bowels in an uproar. We're not going to be talking about mathematics here, okay? Calm down. I'm going to go get a sip of coffee, and you go get one, and we'll continue on very, very soon. All right, got your coffee? You ready to go? All right, let's jump into this. So I said we'd be talking about some definitions up front, and there are 4 definitions. I'll go over them again. It's probability itself, what a probability distribution is, what a standard deviation is, and then what variance is. So I'm going to be putting up some slides that'll cover me over here while we talk about this stuff, and then I can read without looking stupid for you. So let's just get right to it. Stay with me through this, even if you understand this stuff. We're going to have a little example chart of a distribution of adult horse heights so that you can kind of see how this stuff is all used in the real world. So the first slide that'll pop up here is a definition of probability. And as you can read it, or if you can't read it because you're on a mobile phone, probability is a field closely related to statistics that deals with the likelihood of an event or phenomena occurring. It is quantified as a number between 0 and 1 inclusive, where 0 indicates an impossible chance of occurrence and 1 denotes the certain outcome of an event. Well, it's not really between 0 and 1. It's really between, 1 and 100. Because we're talking probabilities. You got 100% of something happening. If I put the gun to my head and I know there's a bullet in there and I pull the trigger, there's 100% probability I'm going to die, or 99.99% chance I'm going to die. So the calculations come out between 0 and 1, but that isn't how we express those probabilities. The next definition that we're going to go to, and let me slide to the next slide, is the definition of probability distribution. A probability distribution is a statistical function that describes all the possible values and likelihoods that a random variable can take within a given range. Holy shit, what does that mean? Well, look, if I had a bunch of adult horses that I was looking at, this is the example, and we found that 5 of them were 4 feet tall, and 60 of them were 5 feet tall, and 3 of them were 6 feet tall. That's a probability distribution. It's the number of things that have a certain characteristic. I've got 5 horses in my sample size of 100 horses that are 3 feet tall, let's say. And I've got 15 horses that are 4 feet tall. So that would be this probability distribution. So let me read it to you again if the slide isn't, if that isn't making it for you. A probability distribution is a statistical function that describes all the possible values and likelihoods that a random variable can take within a given range. Okay, that's a probability distribution. And let's go to the next slide. Bingo. Whoa, what is that? The definition of the standard deviation of a probability distribution. Oh, man. Okay, let's just read through it. The standard deviation is a statistic that measures the dispersion of a data set relative to its mean and is calculated as the square root of the variance. Oh, my God. If the data points are further from the mean, there is a higher deviation within the data set. Thus, the more spread out the data, the higher the standard deviation. Okay? So we're talking about the probability distribution and determining what the standard deviation is. So, okay, let's take those definitions and let's graphically look at them, okay? So let me pop up the next slide, and that's going to be a table listing the probability distribution of adult horse height, okay? So what this table is showing us is that one horse is 2 feet tall. We've got 100 horses in our sample size, okay? We have one horse. So if you add up the numbers there, 1, 5, 15, 71, and 8, you're going to come up with 100 horses, okay? So one horse is 2 feet tall, and 5 horses are 3 feet tall, 15 horses are 4 feet tall, 71 horses are 5 feet tall, and 8 horses are 6 feet tall. So our sample size has a horse height distribution between 2 feet and 6 feet. And in fact, the statistics for the average height of an adult horse is between 4.7 and 5 feet. Yeah, I think that was 6 feet, I think it was. I forget what it was. It's on my blog post. I've done a very detailed blog post about this where I go into the the discussion of this stuff in a lot more detail. So please go to longwoodcurrencytrading.com after you watch the video and take a look at the blog post, which has the same title as this video does. But now, and I want to make a disclaimer here about the numbers and the distribution that I'm showing here. The numbers don't correlate with an average value properly, and they're not going to correlate with the proper standard deviation. But I spread them out like this, or put them like this, because I'm trying to demonstrate a principle, not teach the math. So you got to be clear about that. So all you mathy geeks out there, you go, oh, it's not the average and the standard deviation. Calm down. Take a break, okay? Just as an aside, I'm taking physics in college, right, to get my bachelor's degree, and obviously at the same time I'm taking taking mathematics. So at the particular time that I am studying differential equations in the math department, I'm taking sophomore level mechanics, which uses differential equations in order to solve the physics problems, okay? And so in the math department, we're learning differential equations, we're learning expansions that come out as solutions to a differential equation, and there's one, it's called, for example, you can look it up, it's a Taylor series. It's a repeating number that defines how much precision you want in a result. Like if you're measuring a board that's got to go into a house, and you need one that's 12 feet, 12 feet and 1/8 of an inch to fit in there. Well, that's a level. 12 feet is one level of precision, and if you go to the next one, 1/8 of an inch, that's another level of precision. And for putting boards into houses, that's fine. But if that was a metal beam or rod that was 12 inches and was going to go and fit in precisely in some medical device, then you wouldn't want it 12.1 inch. That isn't enough precision. You'd need it 12.125379. You'd go out to maybe 4 decimal places or 3 decimal places or 6, whatever. It's a measure of the precision of the calculation that you want. Okay, so in the math department, they're very anal about stuff like this, and they say that if you're working with a Taylor series expansion or you're calculating these values from these equations, they go out to many decimal levels of precision, 6, 8 points of precision. You know, the value of pi is 3.14159, blah, 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 blah. And in physics, we look at macroscopic things like a block sliding down a plane. There's resistance there. And so what's the speed differential as it encounters this resistance? What level of precision do you need in order to describe that? And so you don't need that level of precision. So the physicist will look at the same problem that the mathematician is, but the physicist will wave his hands and say, well, we don't need that precision. We're just going to whack it off, and it's 12 feet. That's all we need. And the mathematicians get their shorts wound up really tight about that because it's not precise. But in physics, we're looking for different things out of those calculations. Some of them have to be very precise, but some of them don't, because what the equations do is they describe principles. And so I'm going to arm wave my way through this math to show you that the math doesn't really matter in trading. It's the principle behind the math. So you have to keep that in mind when we're talking about these types of distributions and these types of values and even the probabilities that we come up with. You know, I could very easily look at a graph of something and say, hey, this has a probability of 67% of continuing its upward, its upward movement in its price action. And that's a really rough gauge because it could be 63%, it could be 68%, it could be any number between that. In fact, maybe somebody could argue you can't calculate that it's 60% or 63% or anything because your time frame is too short and therefore you don't have enough data points in order to judge whether that has any probability of continuing to go up or not. So you don't want to get wrapped in trading, you don't want to get it wrapped around the axle in the numbers and the mathematics of it. You have to look at the principles that are involved, and that's where all this discussion of the math is going to go to when we look at the principles of something that are going to happen, okay? So that's a little blurb about that discussion on the table of data that we're going to now go to and take a look at from the standpoint of probability distributions. Okay, I know you guys are going to kill me for this shitty filming here. I'm not Steven Spielberg. I should probably get a better camera. I'm using a GoPro, and they're shitty inside. They're great outside. And so I hope this diagram comes up okay. If it doesn't, then after I'm done going through it, I'll shit can this part of the video and I'll go back and just post it as a picture. But I think spread out like this, it's going to work a little bit better. Look, this is a probability distribution of the data that we saw in the last video. So let's just say that in calculating the average value of horse height, it's 5 feet. And I sort of emphasize that because I made 71 of the 100 horses 5 feet tall. So I kind of forced the issue, but again, the mathematics isn't going to work right. It's the principle that you want to look at. So we've got the mean here, the mean, which is the average. We've got 71 horses that are 5 feet tall. Only 8 of them are 6 feet tall. 15 of them are 4 feet tall, then 5 at 3 feet tall, and there's this one little guy down here, a horse that's 2 feet tall. So remember in the definition from the probability distribution, the further away from the mean that particular height gets, the less likelihood there is for that height to be in the sample size. So we've got, again, if you add these numbers up, 1, 5, 15, 71, and 8, you come up with 100. So this is the mean here in the middle. That's why the bell curve is the highest, because it's saying that the mean from 5 feet to 4 feet or 5 feet to 6 feet contains 68% of the 100 data points that we have in our sample size. So either side of the mean is one standard deviation. And this is where you're getting the variance from. So when you say that your data, most of your data, 68% of your data is going to fall within one standard deviation of the mean. Within 2 standard deviations of the mean, you're going to get 98% of the values. So you can see that I've got 5, 15, 71, and 8 that are falling within 2 standard deviations of the mean, and that's certainly 98% of the sample size when there's only one horse that's a size of 2 feet. So all that the friggin' mathematics is going about to show you is that out of all this data and all of these probability distributions, that this guy out here, this 2-foot horse, is an anomaly. We call this part of the bell curve, when it gets out in here, the tail, because it's very, very small. And you can see that the number, which is represented by the distance from the baseline to here, in other words, 2 feet is here. That's a measurement of distance. This is 3 feet. This is 4 feet. This is 5 feet, the mean. This is 6 feet. So you can see that there are not very many of them way out here, 1, 2, 3 standard deviations from the mean. So when you get out in any probability distribution to 3 standard deviations, the likelihood of that event happening is very small. Okay. The probability distribution you have to kind of have in your head, and you look at trading as a whole, as a system, as a microcosm of life, and you say, out here at this end of the, well, let's see, if you're looking at this, that would be my right hand, and I'd be, okay, at this end of the probability distribution, which is the plus end, the big end, I could make, let's say I'm trading with a full lot, so each pip is $10. At the outside of that, I could go into a trading session and make 1,000 pips on that, and make $10,000. And on the negative side of that, I could lose 1,000 pips. Well, I wouldn't lose $10,000 because I'd have $10,000 as my bank, but as soon as I ran to margin level, they'd ship me out, right? They'd margin call me out. But I'd still lose $5,000 or $6,000 or whatever the margin level happened to be on that particular currency pair at that time. So you can see the probability distribution of gains and losses and where they fit on that distribution. So if you're trading a 5-minute time frame, if you're a short-term scalper, would you expect to make 1,000 pips? Probably not. Where is your expectation on trading on a 5-minute time frame? Well, you might make 20. You might. But that 20 pip probability for you is probably out 2 standard deviations. Well, what's the mean? I mean, everything has to be judged. What would be the average amount you think you could get trading on a 5-minute time frame? And again, this is generic. It's going to depend on the ATR. It's going to depend on the time of day. It's going to depend on the currency pair. It's going to be all kinds of shit that you got to bring into it. But you're familiar with all that because that's what you're trading. That's why you can't trade 6 different currency pairs. If you ever talk to somebody who's going to teach you and they're trading more than one currency pair, don't take classes from them, because they're going to suggest to you reasons why you should and should be able to trade multiple currency pairs. You can't unless you have, I don't know, maybe if you have a couple of years of trading experience, good trading experience, profitable trading experience, would you want to branch out? Look, if you were trying to learn how to play guitar, would you try to learn how to play piano at the same time? It's just fucking music, but they're totally different instruments. Come on, let's be realistic. Come on, you educators out there, if you're listening to this stuff, pay attention to what I'm saying, because you're not doing your students any good here. So in any event, let's say I'm trading on a 5-minute time frame. What would be the average based on, maybe I've got a 63% win rate? My average gain might be 10 pips or 12 pips. And so therefore that's the mean in my distribution. So how many standard deviations out would be from 12 pips would be 20 pips. See, it's going to be pretty far out there. You want to get that out, not 3 or 4 standard deviations out, but you want to get it at least 2, because within 2 you'll have 98%. And within 1, it's 68% of that total. Well, if you're at 68, that's about 70%, right? That leaves 30% on either side of 1 standard deviation out. So if you're 2 standard deviations out with that 20 pip run, that's probably not as practical as a target point as that 12 pip would be, or maybe the 12 pip, which is the average, maybe that goes out to, at the first standard deviation, it goes out to 15. And so you could say, well, anywhere between one standard deviation on the other side would be 11 or 10, say 9. So somewhere between 9 and 15 pips would be a nice place to target a profit target for that trading. So you see how you use the probability? Do you have to do that kind of calculations? You know you don't. You know what you use is you use your experience. And that's the next thing that we want to chat a little bit about. Okay, as you'll see on the screen, I have, this is actually taken right off of the blog post I wrote. So again, I encourage you to watch it, and go and read that blog post on longwoodcurrencytrading.com. Why don't you use statistical probability theory, the mathematics of it, in your trading, whereas you're using it to talk about horses, and it gives you a really good idea of what's valid and what's not. The mathematics I'm talking about, not the principles behind it. And so as you can see from the graphic that's on your screen, the reason for this is that horses are quantifiable, or horse growth is quantifiable, whereas currency price action is not. Horse growth is governed by the laws of, well, let's just call it horse growth biology. Currency prices have no such price action biology. Price action is random and fractal and is not governed by any physical law, either through mathematics or physics. Price action comes about through the economic needs of two countries exchanging goods and services via the translation of their currencies into the currency of the other. You cannot develop experience over the entire spectrum of trading. You're not going to develop the kind of experience that I'm talking about by trying to trade the DAX and Ford stock but concentrating on currencies, and then you're going to slip off and trade gold because you think this isn't going to happen. You need to undertake a path of singularity in your study, and that makes the study easy, because if you learn the principles of trading, let's say a currency pair, and one specific, let's call it AUDNZD, Australian dollar versus a New Zealand dollar. You become, maybe you're an Australian resident, so that interests you. So you become an expert in that currency pair based on principles of learning to trade the correct way, based on certain models that somebody should be teaching you how to build these trading models. For that very simple case, you can then extrapolate that model into other currency pairs, into gold, into stocks, into trading old tires. Doesn't make any friggin' difference, because it's trading, it's for sale. If you try to do too much, if your model is too complex, you're not going to be successful. I know, all you want to do is sit there and trade, you want to get out, and you think you're going to be able to do it. Okay, maybe you will. But I would simply continue to throw up at you, not throw up, that kind of throw up, but throw up to you the statistics that a major retail FOREX broker, a study that they published, over 43 million of their client transactions revealed that 90% of traders lose 90% of their account in 90 days. Why is that? You think these people are fucking stupid? They're not stupid. They're being trained the wrong way, or they're looking at the wrong thing, or they're trying to do too much. You got to find, folks, you got to find somebody that isn't going to show you all that. And second of all, you got to find somebody that's more interested in teaching you how to win instead of how not to lose. How not to lose is really, really, really simple. Why are books written on it? But we all get plugged up with risk-reward ratios and win-loss and blah, 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 and setting stops. Look, your model can't be that complicated. Your model has to be simple. If you know anything about project planning you know that part of project planning is to learn how to develop a PERT diagram, which simply is a diagram that starts out with a line of actions that if nothing goes wrong, this is going to get you from A to B. Let's say you're moving your office from location A to location B. So the thing is that first thing is pack everything up. Second thing is get it out the door and load it on the truck. Third thing is drive the truck to the new location. Fourth is offload the truck. That's your happy path. Well, what happens if when you are loading stuff on the truck that you drop some of the equipment? Well, now you need to branch off of that and say, well, I gotta pick the equipment up, I gotta fix the equipment, and then I can load it on the truck, and then I can rejoin the main branch and go on from there. But that differential that you had to take took time. That's what the PERT diagram shows. And eventually, as you develop this PERT diagram, you'll come up to the worst case scenario. Everybody gets sick and nobody can help move the furniture out. The truck shows up late. You drop stuff coming down the stairs. You run into more street lights, lights than you had anticipated because you're trying to get to the new location by a certain time so that the people that are going to offload the truck are at that location waiting for you. Trading is the same way. And in your model, you can map out all those contingencies. You can look at the best case scenario, you can look at the worst case scenario, and you can see that there are very simple things that you can do to mitigate the worst case scenario. Why the hell would you focus your time on building your model around worst case scenarios? Anyway, and the reason I can say that is because I understand probability distributions and standard deviations from the norm and time analysis of things that happen. And so that's the principle that I'm trying to convey to you, is that when you're developing your model, that model, although it has nothing to do with the mathematics of probability theory, it is foundationed in the principles of probability theory. You don't have to know any math to know the principles. And hopefully this video is going to be more principle focused than it is mathematically focused, because who wants to do math? The chart is 60 pips. So I'd have to wait 60 candles for that to translate over. Well, that's not valid on the high time frames. Again, this is my rule. I was talking to you about my rule. So I'm talking down on the 5-minute time frame. I set up my trades on a 15-minute time frame based on what's going on in the daily and the 4-hour. I do my trade entry and exit and management. I do it on the 5-minute time frame, and then I will go down to the 5-second time frame for when it starts to chatter, because that's where you see the chatter. And so that 5-second may have a 2-pip ATR or something like that. But since I'm managing the trade, I'm running the trade on that 5-minute chart, I'm going to wait for, and that has an ATR of 5 candles, I'm going to wait for 5-second candles, which would be 25 seconds. I'm only giving that thing to chatter for 25 seconds on a 5-minute chart, because, I mean, how much longer are you going to wait? You're in your house and the curtains catch on fire and you're going, well, geez, the curtains are on fire and it's kind of burning, and well, let's see, how long do I want to sit here before I determine that the whole fucking place is going to burn down? You get the drift of what I'm saying? So you have to build the model based on your experience trading a certain currency pair that has a certain ATR that is on a certain time frame, in order to build these metrics that you have in your mind that you're comfortable with as the characteristics of your trading. And then you have to add into to the sauce the secret pixie dust of your personality. Are you geared for longer term trading, but you're down on the short time frames? That's going to make your roids flare. So you have to look at your character and your personality, how you react to negative action when you have a big gain, as opposed to a negative action when you have a small gain? How do you respond to all those particular situations? How does that affect you from a psychological standpoint? Those things all go into building your model. But you don't sit down on a piece of paper and write this stuff down. You have this stuff in mind, and it's easy to do that because you're only trading that one pair on that one time frame. And so after a period of time trading in a sim account or trading a small live account, you begin to see how that currency pair is behaving and how you react to that. And then you can determine what your rule is going to be. If you're trading on a 5-minute time frame and it starts to chatter and you're looking at that chatter on a 5-minute time frame as opposed to the 1 minute or going down in value, and you think you want to wait a set time, like I'll wait 10 minutes or I'll wait 3 minutes. Well, it doesn't really make any difference. It's the principle of the thing. How long are you going to let that thing chatter before you say, man, this thing has an equal probability of now turning around and going against me as it does of continuing up? That's when you get out of the trade. When you're a jump ball, that's not a decision you make. Oh, geez, it was going up before, so now it'll stop this chatter and it'll turn around and go up. No. It's 50-50. It's jump ball at that point. You have no probabilistic value that's higher that it will go up. There's no probability that the thing will go up. It's 50-50. That's your probability. Are you going to bet your life on the flip of a coin that's a 50-50? I don't think so. Why would you risk your money? So you have to understand the value of your intuition that's based on your experience, which is foundation in probability distribution theory. Well, I hope you've enjoyed this. I hope it didn't cause you to have your roids flared up. But if you have some questions, throw them down in the comments or send me an email. Don't put them in the comments. Send me an email and we'll chat about it. And maybe from those comments or from the emails that I get, we'll do another video on this that's more in line or has less detail in some areas or more detail in others. Because again, it's not the stuff that I'm trying to convey to you. It's the principles. And that's why I don't do graphs and charts and all that other kind of stuff, okay? So Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.